Well, if you have to closely follow a company, you shouldn't own it.
In today's internet age, anyone from practically anywhere can share their opinions and advice to the world. We are connected in so many ways with so many devices and so many open platforms, providing the opportunity to voice your experience to others, seeking the wisdom that you have acquired throughout your life. But it's not every day that you receive a piece of advice that single-handedly changes how you act or behave in a given field. So in today's video, I'm going to share with you the best investing advice I ever got and how you can use it to improve your long-term returns. I began investing in early 2017, and while I did have a strong background in mathematics at the time, I had a lot to learn about how the markets functioned in a partially irrational environment. My early investments were made almost entirely focused on the PE ratio, which compares the price of a stock to the profits of that stock from the previous year. I would look to see if the PE was lower than the market average, I would see if it was lower than the competition around it, and I was looking to see if it was lower than the company's historical average. And while comparing the price of a stock or business to the earnings behind that business is heading in the right direction, there are substantial flaws in focusing on just a single earnings multiple or earnings ratio. For example, the PE ratio tells you absolutely nothing about the financial health of a business, that being how much debt do they have and how much cash and short-term assets do they have to cover those debt obligations. The PE ratio also tells you absolutely nothing about how the industry might grow in the future. And it also frankly tells you nothing about the management team, who are the people that are making decisions on our behalf. Throughout 2017, I used what I was learning in books as well as at university to start to develop a further understanding of what I'm supposed to be doing when I was investing. I started to read a lot more about the companies that I wanted to invest in. Rather than just looking at 3 years of past financial data, I started looking at 10 years of financial data to see how the long-term track record of this company had been. I started looking at industry data and I started looking at the people who were managing the company. And at this stage, I was certainly becoming a much better decision maker when looking at businesses to invest in, but ultimately I still lacked a fundamental strategy that could be the foundation of all my investment decisions. In layman's terms, I had yet to figure out what the purpose of investing was. And then one day I came across a clip of Warren Buffett lecturing to university students about the value investing strategy that he had used to substantially outperform the market. And while I have read and listened to just about everything Buffett has ever said, there is a 30-second clip during this lecture that permanently changed the way I think about investing.
If you buy Coca-Cola today, the company is selling for about $110 to $15 billion in the market. The question is, if you had 110 or 15 billion, you wouldn't be listening to me, but I'd be listening to you incidentally. But the question is, would you lay it out today to get what the Coca-Cola company is going to deliver to you over the next 200 or 300 years? The discount rate doesn't make much difference after as you get further out. And that is a question of how much cash they're going to give you.
How much you're willing to pay is determined by the total amount of cash that a business can return to you in the future. And while this sentence seems so simple, it is the cornerstone of every decision that you make when you're researching and analyzing businesses as investments. Let me show you how. From that point onwards, my investment strategy was built upon that very simple concept. I first started asking, well, how is cash returned to shareholders? And I quickly figured out that it was returned to shareholders in two major ways. One, through dividends, cash payments directly to the shareholders, decisions made by the management team. And the other way is through the stock price going up. So my next question was, how do we determine how a stock price is going to move in the future? And I quickly learned that in the short term, this can be very, very unpredictable, but over a long period, over a 10-year period, if you look at how the profits of a business grow, how the cash flows of a business grow, that will be reflected in the stock price over the long term. And now that I know that the cash flows of a business affect how much a management team can pay as a dividend and the stock price increases of a business over the long term, I needed to determine how could I estimate those future cash flows. Having this philosophy as a foundation helps you to figure out what is important and what is not. Suddenly, I wanted to avoid companies with high levels of debt because they came with an increased risk of getting no cash back in the future. Then I only wanted to invest in companies with trustworthy leaders in power because their decisions would impact how successful the business was. I also stopped caring about the stock price movements of a business in the short term because I realized that the movements of the stock in the past tell us absolutely nothing about where the stock is going to go in the future. That would be dependent on how profitable and how cash flow friendly the business is in the future. And then I also stopped caring about short-term economic and industry news. I realized quickly that most of the news that comes out on a daily basis has an impact that lasts about 2 seconds and has no financial impact on the success of great businesses over the long term. So now let's make this video super practical for you. How can you use this piece of advice in the same way that I did in order to improve your long-term returns? And really, it comes down to a 4-step strategy that I was able to develop through focusing on that piece of advice and deriving every decision that I make from that piece of advice. So let's start with the first component of this 4-step strategy, which is what is called circle of competence. This is a term that was coined by Warren Buffett, and it's used by many value investors to describe what we do when we invest in areas that we completely understand and avoid businesses immediately that are in areas that we don't find interesting or that we just don't have enough competence in, that we don't understand how the industry or those businesses work. And it is super important that as an investor, you do not skip this stage of the analysis, because everything else that we do later in analysis, looking at management, estimating future cash flows, looking at competitive advantages, all of those things hinge on us having a deep understanding of the business and the industry in which it operates. So that means that you need to go out and learn as much as possible, first about the industry and then about each of the businesses within that industry. And this task seems very daunting, but it can be easy once you break it down into some simple steps. The first thing you want to do is you want to go out and think about some industries and some markets that you are really interested in, or maybe you are a consumer in that industry. So you're purchasing things in that industry regularly, and you have a deep understanding of which products are consistently purchased more than other products, and not only which ones are more popular than others, but understanding why that product is more popular than others. And beyond that, you want to develop a deep understanding of the industry. So you need to understand how are products made in that industry? How does it get from the raw materials in the ground to in a customer's hand? Or if it's a service business, how does the business operate? What are the rules that govern that business? And what is the customer getting? And how is the business serving that to the customer? And this stage of the analysis is not something that you can do in a finite amount of time. It's a continual practice of developing a deeper understanding of the industry. So at first, you might pick an industry. If you're brand new to this kind of style of investing, you'll pick an industry and maybe you learn about it over the course of a week. And over a week, by doing some regular reading, you can actually learn quite a lot about an industry and a particular business in that industry. But if you're investing in that business for 10, 20, or 30 years in the future, which is ultimately what we would love, is to find businesses that we can hold for 20 or 30 years, then you are going to be continually developing a deeper understanding over that time, and you will become a better investor in that business over time, because coming back to the piece of advice, the more that you understand, the better you will be able to predict how much cash that business is going to return to you in the future, and you will be able to predict when are the best times to pick up more stock and when are the best times to maybe let some go or just to hold onto the stock and wait for a better price. The second step of the analysis is looking for competitive advantages. So coming back to the piece of advice, we're trying to estimate how much cash can be returned to us. And for many businesses, businesses, doing that is going to be nearly impossible because many businesses are new on the stock market and they have not yet established themselves as a significant leader in that industry. And as a result, it's very difficult to see where their future lies. Maybe they go bankrupt, or maybe they become the leader in the industry in 10 years' time. And if that's the case, then the business has such a wide array of future outcomes for cash flow. So what we want to do is we want to narrow that array to businesses that we are highly certain are going to be thriving in the future. And how do we do that? We look for competitive advantages. The business needs to have what Warren Buffett would call as a wide economic moat, something protecting the business from other businesses in that industry. The third step in the analysis process is to look at management. And management are the people who are actually in the business, in the offices, making decisions on our behalf. And the collection of their decisions in the future will be the outcome of how much cash is returned to us, which is why we need to focus on management. You could imagine having two businesses that are identical. So we have two businesses in parallel universes that are the same business, but one has a shoddy manager who cares about his own personal pocket, and the other has a founder who cares about seeing that business thrive and become the biggest business possible. Both of them sell the same product and they have the same services or whatever, it's the same business. But this one is going to produce a lot less cash for shareholders because this manager cares about lining his own pocket, whereas this one cares about seeing the business thrive to the highest level. And again, you can see how focusing on management comes back to that single piece of advice, which is focusing on how much we're going to get back from an investment. And just to give you the headlines of management, we focus on management in three distinct ways. The first is their honesty to us and their belief in wanting to see the business become successful in the future. We call that management's integrity. We then have management's skill at investing and managing debt, because debt is one of the things that could cost us a lot of money. It could make the future cash inflows of the business highly uncertain. So we need to make sure they have low levels of debt. And then of course, the ability of a management team to make good investments within the business, to buy the right buildings, to invest in the right people. Those decisions will ultimately again impact how much cash we get back. So we need to focus on that. And the measure we use for their ability to invest within the business is the return on invested capital. And then finally, to bring it all together, we actually need to go out and have a method for estimating the future cash flows of a business. It's kind of like the first three stages are making sure we have a strong and stable business that we have a lot of confidence in and that we deeply understand. And then we go into intrinsic valuation, which is the actual practice of coming up with an estimate of future cash flows. And you can use something like my free spreadsheet resource, which is down in the description below, in order to help you go through that process. So now I want to throw it back to you. What is the best piece of investing advice that you have ever received? Let me know down in the comment section below. At some point along your journey, I'm sure that you read something or that you watched a video or you listened to something and you heard some piece of advice that had a lasting impact on the investment approach that you take and the way that you go out researching and that sort of thing. So let me know what that was down in the comment section below. And as always, if you enjoyed the video, I would very much appreciate it if you could leave a like. Make sure you hit subscribe if you haven't already and you want to see more content like this. But for now, I will see you guys in the next video.